competition that's out there doesn't really offer this at all. They're kind of a one-trick pony, and that's because they borrow from institutions where they have a cost on their money, which they can't really deviate from their target, basically, or their business model. They can't do any of this. We're obviously privately funded, so we can be a lot more flexible when we're coming up with terms. We can customize any type of deal to make it fit that client's need. Whether we give them $30,000 now and an additional $20,000 45 days later, the competition can't do any of this. Secondly, on the banking products, there are 3 methods of payment. Depending, again, on their FICO score, the term, and the amount of money that they're taking, they can pay back on either a weekly basis, a monthly basis, or a daily basis, meaning that a fixed ACH product would come up with a Monday through Friday an exact dollar amount, which we would then ACH out of their bank, which are only for riskier industries, riskier merchants, lower FICO score guys. Still based off interest, still stretched over a longer period of time, but it's just coming out of their bank account Monday through Friday as opposed to their Visa MasterCard sales.
What does ACH stand for?
Automatic cash. I'm sorry, what was that?
I think it's clearinghouse.
Correct. It's a clearinghouse, so we automatically pull the money out through an ACH bank process. Caught me off guard there, Lane.
Sorry. Sorry.
Automatic clearinghouse.
Got it. Okay.
Yeah, kind of similar to the debit card. It's similar to a debit card process. Somebody uses, but it's automatic, check by phone, like that.
Correct. And again, this is just a way for us to secure our money. We're not making these guys sign personally for anything, so there's no personal guarantee on any of these types of loans. And in return for that, you're giving a guy with a 600 FICO score money at 12%. Where else can he go? He really can't, so we're asking you to secure this through your receivables.
No personal guarantee. That's huge, because even factors usually have a personal guarantee.
Correct. There's no personal guarantee on this whatsoever. It's only on the receivables of the company. We do file a UCC or a blanket UCC on the company itself, but that is really it as far as security goes. We do a lot of underwriting, which basically lets us know whether or not they're going out of business the next 6 to 8, 9 months down the road, which is a lot more intuitive on the back end, which is a whole different conversation.
So if somebody's sales are falling, do you not lend to them if they're declining? Do you look at that?
Correct. On the banking products, we typically get more statements, usually a 12-month bank and 12 months credit, but we'll get them preliminary numbers before we actually fund them just to get an idea as to what we can offer them. However, if we look at year-over-year numbers, and last April they did $120,000, and this April they did $30,000, that's a pretty good sign that something's wrong and we're not really comfortable doing the deal.
Okay. That's on the banking product? I'm a little confused.
Correct. It is confusing. We need the same documentation for all 3 of these products.
Okay.
So in order for us to get you pre-approval numbers or pre-qual numbers, basically we'll need the 3-month bank, the 6-month credit cards, and the application. From there, we'll get an idea as to what we're going to be offering you. We'll give you preliminary numbers and options, and then if you choose one of those, there's additional documentation after that that we'll be requesting. However, in order for us to give you a yes or no answer with the funded amount, all you need are those 3 different items. So we want to keep it as basic as possible, because for somebody to send us tax returns and leases and all sorts of stuff, and for us to just say no, that just doesn't make too much sense.
But I think what Richard's asking there for clarity, if they, let's say they did not qualify for the banking product because they were 120 last April, now they're 30 this April, would they still qualify in that example for the factoring product?
Yes, absolutely. It wouldn't make a difference. We just would probably not fund them as much money as they would previously be qualified for.
And it would be a higher rate, shorter term kind of a situation.
Correct. Short-term debt is what, we're really looking for, is how quickly can we get the return on our investment pack, and how safe is the deal. If the deal is a very safe deal, and the guy's using it to purchase inventory, which we proofed up, or some crazy purchase order, we'll stretch it, over a much longer period of time, which the competitors kind of are wide-eyed when they look at the offers that they know they can't compete with.
Right. So the idea here is we're looking to get them the best deal that they'll qualify for within the scope of your 3 different product lines, and then tailor that product to make the most sense for that particular merchant. I mean, that's
Correct.
kind of what I feel here. Okay.
Correct. And then we always allow more money to come back. And what we have, which nobody else really does, is an online portal where they can kind of manage the advance that they have, what their average payment is, how much their balance is. All this stuff is online access for them. We also give them a monthly statement. So the transparency is there for them, which a lot of these guys do not do, which unfortunately has given the industry not a bad name, but some of these guys, a few bad apples, have taken, a couple extra dollars here and there, and then at the end they refund it back. That's not at all what we're about, which is why we spent a lot of money on these back-end systems that they can kind of manage it all. It allows a lot more transparency for the merchant rather than having us have complete control. So if these guys are dealing with a competitor that does not have this, this is also another benefit for them to go more towards you than anybody else.
Okay, great.
So, I have this slide comparing conventional factors. Could you explain the difference between what you do and what a factor does? So again, what is a factor and how are you different?
Sure. A typical factoring company or a commercial receivable factor is a lot cheaper than what we're doing, and it's much higher dollar amount. We'll fund anywhere from $3,000. Our average deal ranges from $25,000 to $45,000, whereas a commercial factor company probably wouldn't look at that. It would be much too low a dollar amount. They're looking for $500,000 plus with multiple different purchase orders in order to factor. We'll do it as a quick cash injection just based off your monthly receivables as a daily basis. So we're getting paid back every single day, where a factor might take a specific percentage off and take it in from that purchase order. Our prices are typically higher than a commercial factor. They're anywhere from a 1.02 to a 115, and we're anywhere from a 115 to a 138. So
how is that expressed? Those numbers as what? What do those
15
mean?
cents off the dollar to 38 cents off the dollar. If you want to get the total payback amount, you can do 20,000, or we'll do $10,000 times 1.38. You'd be paying back $13,800. So you do 10,000 times 1.38 would be a payback of 13,800.
Okay. The reality is this is very, very expensive money. It's not money that somebody really wants to get, but it's the only option, and for some people it's a lifesaver. I mean, let's just be frank about it, right?
Correct. Conventional institutions have just stopped lending to these people. And I mean, even at the cheaper rates, a lot of these guys are the good guys that you have, that you build a rapport with. You'll realize that they have factored into their business plan a cash advance with this cost of money. We do a lot of furniture companies that are able to buy their money when inventory pops up in China, and right in their business model they have a merchant cash advance. So the cost of the money is associated with their actual balance sheet. So those guys, I mean, they really know what you're doing, and those are typically safer deals, and they come back every 4 to 6 months for more money, almost like a line of credit or an inventory line, which is great for them because they know that it's there when they need it, and they can get it very quick.
Right. So how do you differentiate yourself with other merchant account funding companies, lenders?
Sure. One of the biggest differences is that we're privately funded, so our cost of our money is par none compared to what the competitors are. There are a few others out there, and I know them very well, that have the same kind of model that we do.
Yes.
But as far as the costs are, our costs are less, so we can sell for less. We're not borrowing money at 20 or 25%, which we know we can't do certain things on if we were doing that. The way we're funded, we have free reign. There's no red tape to go around when we're trying to create some sort of financing program for these guys, which if they're working with us and they're working with somebody else, I love that because I know they can't compete, and it's kind of like, all right, we'll take this offer back to them, and if they can beat it, let me know. And they can't. They always get the runaround, and they always, say this, that, and the other, and nothing ever comes to fruition with them. Whereas opposed to us, it always does. Number two is that we can do the creative kind of stuff, whereas we give them $20,000 now, an additional $20,000 45 days later, just to stretch the term out over a longer period of time. The competitors do not do that. It's a very set amount. They can't take any kind of discounts when they're paying back, which is something that we can do, and nobody else really can.
Can you explain that? What does that mean, discounts when paying back?
If somebody comes back and they want to pay you off 2 weeks later, they won't take any discounts because of the way they're borrowing their money. With us, we'll say, okay, yeah, we'll knock $10,000 off the RTR, or the right to receive, the total payback amount. If you pay me back in 2 weeks, of course, I'll take 20% for 2 weeks. Who wouldn't?
Right.
So these other companies will not do that. Thirdly, we do have the online reporting, which is a very big benefit to the merchant themselves. Fourthly, we do the flex funding, which is the line of credit, which everybody loves. They can come back at any given time and get additional money. With the other companies, they just cannot do that because of the way their business model is.
Okay. And I've got a slide here. We're just showing the different types of merchants that you're funding. Restaurants, automotive, food, beauty and barber, and grocery are probably the biggest items.
Correct. In the broad industry, or an industry as a whole, those are the largest industries that we kind of target, and it's specifically because banks just will not lend to those. This whole entire industry was basically sparked because restaurants could not get the money they needed because of those numbers I had mentioned previously. So it was all geared or founded based on restaurant financing, and it kind of deviated from that to retail stores, to other types of institutions that cannot get traditional money. But we've done everything from law firms to real estate companies to collection agencies. Depending on their profit margins, if we can make it make sense and they do accept credit cards, we can probably take a stab at it.
So do you still do a lot of restaurants? Is like probably the biggest source of your business?
Absolutely. Restaurants, we love them. We understand their business.